Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, let's get right into it. Today, we're going to talk about a seriously powerful and, let's be honest, often misunderstood strategy for building wealth. We're talking about using real estate investments to just slash the taxes you pay on your main income. I mean, just stop and think about that for a second. What if you could take all that money you make from your job, your W-2, or from your business, and legally use a real estate investment to completely wipe out the taxes you owe on it? It sounds almost too good to be true, right? Well, it is possible. So this slide, this is the dream scenario. On the left, you made 200 grand. Nice. On the right, your investment property created a $200,000 paper loss. Now, this isn't you actually losing cash from your bank account. It's a deduction the IRS lets you take, mostly through a magical thing called depreciation. If you can legally smash these two numbers together, your taxable income just dropped to zero. But, as you've probably guessed, it's not quite that simple. The IRS knows all about this strategy, and to stop everybody from doing it, they've built this massive invisible wall right down the middle of your financial life. And this wall has a name. It's all built on the IRS's big idea of splitting your life into two different categories: active and passive. See, the wall is officially called the Passive Activity Loss Rule, or PAL. The concept is actually pretty simple. The IRS says you have two separate buckets for your money, and any losses that happen in your passive bucket, which by default includes most rental real estate, can only be used to cancel out income in that same passive bucket. And this right here illustrates the problem perfectly. Your salary, your business profits, that's all in the active bucket. Your rental property's paper loss, that's in the passive bucket. And that giant X in the middle, that's the wall. It's a hard stop. The IRS says you cannot let those passive losses cross over and touch your active income. So how in the world do you get through the wall? Well, the method that pretty much everyone hears about first is getting a special golden ticket from the IRS. It's about officially becoming a real estate professional. But here's the catch, and it's a big one. This isn't just a title you can give yourself. To earn it, you have to pass two very strict tests. First, more than half of all your working time has to be in real estate. And second, you have to log over 750 hours a year doing it. For anyone with a demanding career, a doctor, a lawyer, a software engineer, this is, let's face it, pretty much impossible. And honestly, this is where most people's journey just stops cold. They see these requirements and think, well, I have a real job, so I guess it's game over for me. But here's what I really want you to hear today. It is absolutely not game over. Because what most people don't know is that there are other, smarter paths. Not through the wall, but around it. And we're going to walk through two of them right now. Okay, our first strategy is all about reclassifying your property. It's a really clever workaround. Instead of trying to break the rules, we just make it so the rules don't even apply in the first place. Here's the key. Remember how the passive activity loss rules specifically apply to rental activities? Well, what if you could run your property in a way that the IRS no longer sees it as a simple rental? Then it's not automatically passive, and for that specific property, the wall just crumbles. So how do you do it? You have to meet one of two tests. The first one is super straightforward. The average stay for your guests is 7 days or less. Think of your classic Airbnb or vacation rental. The second option is an average stay of 30 days or less, but, and this is important, you also have to provide substantial personal services. We're talking about things like daily cleaning or maybe an airport shuttle. If you can meet either of these tests, congratulations, it's now legally a business, not a passive rental. Now, every strategy has a trade-off, and this one has a big one. The huge pro is that your paper losses can now offset your W-2 or business income. That's the whole reason we're here. But the con is, if you actually make a profit, that income is now treated as active business income. And that means it gets hit with self-employment taxes, about 15.3% for Social Security and Medicare. All right, let's switch gears to a completely different approach. This one's for the business owners out there, and it's all about using a corporate structure to your advantage. So the key insight here is that those passive activity loss rules we've been talking about, they're really written for individuals. The game changes when a corporation owns the real estate. The big idea is this. You have your corporation own both your active business and your investment property. This lets the profits from your business and the paper losses from the real estate all get mixed together inside that one company. But, and this is critical to understand, this method can only shelter the corporation's own business income. It can't be used to offset an individual's W-2 salary from some other job. Now, before you run out and set this up, you probably guessed it, the IRS has put up a couple more roadblocks. There are exceptions that bring those pesky passive loss rules right back into the picture for two very common kinds of small businesses. And here they are. The passive activity rules still apply to what are called closely held corporations. That's basically any company where 5 or fewer people own more than half of it, which, let's be real, is most small partnerships. And they also apply to personal service corporations. This is a huge category that covers most professional practices. We're talking law, medicine, accounting, consulting, architecture. For all of those, the wall is still standing. Okay, I know that was a lot of technical detail, so let's pull way back and just summarize the paths we've talked about and leave you with some final thoughts. So we've really identified 3 potential paths around that wall to use those valuable real estate losses. Path 1, the really high bar of becoming a real estate professional. Path 2, the clever option of running a short-term rental business. And Path 3, for some business owners, using a very specific type of corporation. But here is the most important takeaway of this entire explainer. Even if none of those 3 advanced strategies are a good fit for you, please do not think that real estate isn't an incredible tax-advantaged investment. It absolutely is. And here's why. First off, depreciation can often completely wipe out the rental income a property brings in. That means you can be collecting positive cash flow, money in your pocket every single month. That is effectively tax-free. And second, for any business owner listening, if you buy the building that your own business operates out of, that property is an active part of your business. All of its depreciation directly reduces your business income. No special rules, no hoops to jump through. So we've laid out the map. We've shown you the rules of the road, the walls the IRS puts up, and the different routes you can take. The question to leave you with is this. Now that you know the paths, which lane could you start building for your own financial future?